Okay, let's unpack the headline that had everyone scratching their heads last week.
Oh, yeah, the big one.
Meta just spent what reliable sources are calling billions of dollars acquiring a firm named Manus AI. And the public reaction, I mean, honestly, was just pure confusion. Why is Mark Zuckerberg pouring heavyweight money, billions, into a company whose main job seems to be making, really polished research reports and PPTs?
Right. It looks like a very, very expensive PowerPoint generator.
Exactly.
And that paradox, that's the perfect starting point for this deep dive. Because if you look at the scale of the money, and we're talking probably in the $2 to $5 billion range, this isn't just an expense.
No, not at all.
Our sources confirm this makes Manus Meta's third largest acquisition ever.
Third largest. That's a serious strategic commitment. I mean, we're talking about a deal that's almost shoulder to shoulder with WhatsApp and Oculus.
Precisely. And so our mission today is to cut through that confusion. Is this a huge overspend, a colossal mistake, or is it a critical strategic masterstroke?
And you think it's the latter?
We believe it is.
Huh.
This deal wasn't just about the tech. It was about building a commercial closed-loop system and, maybe most importantly, blocking competitors.
You mean like Microsoft and OpenAI?
Exactly. Blocking them from controlling the money flowing from Meta's own traffic.
So if it's pure strategy, it has to create synergy, right? It can't just be a financial buy where you hope to make your money back someday.
Absolutely. Strategic mergers have to pass that test. 1 + 1 must equal way more than 2. The goal isn't just, marginal growth.
It's a force multiplier.
It's about creating exponential future profits by connecting what Manus does with Meta's massive, and I mean massive, under-monetized assets.
Okay, well, let's establish the scale here because Zuckerberg has a clear track record for this. He's not really known for nurturing small startups.
No, his style is different.
He prefers to just smash heavy money into acquiring mature, established companies that already define a market.
That's the blueprint. And to really appreciate the scale of this Manus deal, we should quickly look at that shopping list.
Okay. The biggest one in terms of sheer capital was Scale AI. That was valued at $29 billion, and Meta spent $14.3 billion for control.
That's just a staggering amount of capital.
It is. Number 2 was WhatsApp. $16 billion back in 2014, which was really about securing an entire domain messaging.
And now Manus slots in at number 3.
Right. Then you have Oculus, $2 billion in 2014 for this hardware platform. And of course, Instagram, $1 billion in 2012 for photo social.
So historically, when Meta spends this kind of money, it's buying an entire category.
Exactly.
So Manus represents the automation category. But what about the technical side of it? Is the company just being absorbed into Meta?
It seems to be a very careful, targeted integration. Manus will plug directly into the Meta AI toolset, but, and this is important, it's going to keep serving its existing paid members.
Oh, that's interesting.
Yeah, they generate about $100 million in annual revenue, and they're keeping their Singapore operations, which will double as a new recruitment hub for Meta's local AI team. So not a dissolution, but a strategic integration.
Right. Preserve the expertise, but align the output with the grander strategy.
Okay, now we need to look at Meta's internal report card. Why do they need this huge strategic buy right now? I know their internal AI path has been, well, let's just say controversial.
Controversial is a kind word for
That's
it.
fair, yeah.
The AI journey has been bumpy. You had internal friction, like the public dismissal of Jan LeCun and these, new directions being questioned all the time.
Right.
And what's really crucial to understand is their latest foundational model, Avocado.
Avocado.
Yeah. And this model is basically being distilled from 3 different already established open source models. We're talking Quinn 3, 235B, Google's Gemma 3, and OpenAI's GPT-OSS.
Wait, hold on. They're distilling 3 other open source models. What does that signal about where Meta is at?
It signals urgency.
Yeah.
And a lack of proprietary foundational control. They're using existing building blocks because they need to deploy AI capabilities fast.
They can't afford the time for fundamental research.
Right. Exactly. They can't afford the years and the billions to catch up with proprietary models from, say, Google or OpenAI. They need a fast path to application, not foundation.
And there's another major positive pivot for them, the metaverse.
Yes. Sources confirm Meta has finally admitted defeat on the metaverse. They're cutting spending, cutting personnel.
Which everyone sees as a huge positive.
A critical positive. It lets them refocus capital. And remember, their traditional ad revenue is still incredibly strong. It's growing rapidly. The core engine is safe.
So the real need is to protect and grow future non-ad revenue.
That's the strategic necessity right there.
This is where it gets interesting. Let's try to reverse engineer this. Let's use a process of elimination. Why did Meta have to buy a company like Manus? And why did they pass on the other giants out there?
This really gets to the core of the strategic thinking. So Meta looks at the AI landscape, and first, they realize what's out of bounds. Foundational AI models.
Like buying an Anthropic.
Impossible. It's valued in the hundreds of billions, and it's already locked up by rivals like Google and Amazon. They just cannot buy that infrastructure layer.
Okay, so they can't buy the foundation. What about consumer-facing apps? The seaside stuff, like, advanced chatbots.
No strategic fit. And this is key to their criteria. A seaside firm talks directly to consumers.
Which Meta already does.
Right. They already control the traffic through Facebook, Instagram, WhatsApp. Buying a firm like Toki wouldn't create new domain growth, which is, the historical reason for their big buys.
It's just buying an app to use with their existing users.
And that market is fragmented. The top teams get poached. The value just isn't there for them.
Okay, so no consumer apps. What about development tools, like AI-powered code editors?
That's a total mismatch with Meta's DNA. Meta just lacks the historical depth in the developer domain that a Microsoft or a Google has.
Right.
Buying a company like Cursor wouldn't create synergy because Meta doesn't really have the internal engine to leverage it effectively. They're not a developer-first company.
So that leaves us with B2B agent companies, businesses that automate tasks for other businesses. But there were huge, very attractive companies in that space they passed on. Why Manus over the known leaders?
This list is so revealing. They looked at Canva, valued at $42 billion, way too costly, and the synergy with Meta's core business is pretty low.
Great for ads, I guess,
Yeah.
but not a core automation solution.
Exactly. Then you had Perplexity, valued at $20 billion. Again, high cost. But more importantly, that team is laser focused on going public on an IPO.
So they'd be hard to control.
Incredibly hard to integrate. You can't spend billions on a highly independent team that's just going to fight you every step of the way.
Yeah.
If you're paying a huge premium for a strategic piece, you need total control.
Makes sense.
And then look at Notion, $11 billion valuation. Notion is a fantastic product, but it was just strategically unsuitable for Meta.
Why?
It's simple. Meta already failed, and failed spectacularly, in the office and workplace sector. Their own product, Meta Workplace, was shut down in September 2025.
So throwing $11 billion at another workplace tool would just be...
Zero strategic sense.
Yeah.
It's a domain where they've proven they just can't execute.
So they needed a B2B agent that was powerful, that they could integrate, and crucially, one that was not focused on that traditional office sector where they already crashed and burned.
Which brings us right back to Manus. And the sources point out that the other candidates, Mira, Grammarly, they were often valued on inflated 2021 prices. They were shrinking tortoises.
Whereas Manus was.
Cash-rich, not desperate, and perfectly aligned with their real need.
But let's talk about that price premium. Manus's last confirmed valuation was $500 million. If Meta paid $2 billion, maybe more, isn't that just inefficient even for strategy?
It's a massive premium, but it was a necessary one. When you're making a strategic buy this critical, you have to pay substantially more.
Why is that?
You're signaling your intent. You're showing you're serious about owning this layer, and you avoid the impression that you're just, buying junk or haggling over a small price gap.
And Manus had the negotiating power.
Absolutely. They had cash flow, $100 million in revenue. That's small for Meta, but it meant they weren't desperate. The buyer, Meta, was the one in a hurry.
So that $100 million in revenue is basically irrelevant to Meta's $100 billion plus income.
Negligible.
The value isn't on the balance sheet. It's entirely in the strategic effect. So what exactly is Manus's core capability that justifies this massive amplification?
Well, we've been calling it the PPT maker, but that really minimizes the complexity. Manus specializes in highly structured, compliant, call it deep research synthesis, and then automated results delivery.
Based on very clear prompts.
Right. They can take an ambiguous need for data and produce a highly polished, simple, and most importantly, automated output. It could be a presentation, a formatted report, or even a small functional website.
But why couldn't Meta just build that themselves? They have unlimited engineers.
Because Meta has historically failed at B2B. We just talked about Workplace. And remember, the customer CRM acquisition, that failed too. Customer bought itself back out in 2023.
So they needed to buy the expertise.
They needed an in-house, compliant, and controllable B2B automation tool that integrates seamlessly with their traffic platforms. Buying was the only viable path after so many internal failures.
Okay, let's connect the dots. Let's connect Manus's automation engine to that multi-billion-dollar revenue stream. Where does this integration actually happen?
The target is crystal clear. WhatsApp Business. This is Meta's version of WeChat Work. It's used by countless advertisers and businesses all over the world for lead gen, group control, direct customer communication. It's a massive river of business traffic just waiting to be monetized.
And that's where the competitive threat was coming from.
Exactly. This is the main tension that forced this acquisition. Competitors, specifically OpenAI and Microsoft Copilot, were building sophisticated AI chatbots that plugged into WhatsApp Business.
So they were monetizing Meta's own traffic.
They were. They were running services, generating revenue from Meta's infrastructure and users, and Meta wasn't seeing a dime of that new revenue.
So Meta was basically letting its rivals siphon off the future AI monetization of its own user base. That's an existential threat.
It is. And our sources confirm Meta recently took the necessary countermeasure. They blocked all third-party AI chatbots from WhatsApp Business completely.
That's planting the flag.
It's Meta saying, we alone will control this monetization layer.
And if you block the third-party solutions, you desperately need a first-party solution, and you need it fast. That's Manus.
That is the final, most crucial role for Manus. Its core capability automation will be used to build a robust AI-powered system. Think automated CRM, marketing analysis, group control, sales conversion, all specifically inside the walled garden of WhatsApp Business.
So Manus isn't a PPT maker for Meta.
No. It is the critical automation layer for a multi-billion-dollar traffic conversion system. It's designed to close the monetization loop for Meta's advertisers and block rivals from their income stream.
So if we synthesize this whole deep dive, the Manus AI purchase was fundamentally a defensive, I guess an essential strategic move.
I think so.
It wasn't about finding a new market. It was about making sure that Meta, and not its competitors, controls the AI monetization of its huge, valuable, and largely untapped WhatsApp Business traffic.
That is the final takeaway. It's a land grab. It's a land grab for the automation layer that ensures Meta gets the maximum value from its own users. Without that proprietary layer, that huge traffic stream is porous, it's vulnerable, and it cripples their next wave of income growth.
And that, I think, brings us to the final provocative thought here. The strategic intent is impeccable. I mean, the logic behind blocking competitors and closing that loop, it makes perfect sense on paper.
And it's a big but. The actual success of this deal, like with all huge corporate integrations, rests entirely on execution.
Right.
And the sources are quick to point out that these large-scale integrations have a historically high failure rate. The ability to seamlessly fold Manus's very specific capabilities into the complex, often challenging metastructure, that's the real test.
So the strategy is sound, but the follow-through is everything.
We know the destination they want to reach, but the actual path of product evolution. That's what will tell us if this multi-billion-dollar gamble truly pays off. This is definitely one to keep a very close eye on in Meta's stock performance and their product roadmaps over the